Okay, let's get right into it. We're going to tackle a question that honestly feels like it's from some upside-down world. It's a real economic mystery that's hitting millions of us. How is it possible that fewer people than ever can actually afford a home, but somehow prices just keep going up? It pretty much breaks the first rule of supply and demand, right? So let's dive into this paradox.
Right. This is the big question. It's the one that keeps you up at night. You see the headlines. You hear the stories from your friends who've been outbid for the 10th time. You look at your own bank account and it all just feels impossible. And yet the market keeps churning. Somebody, somewhere, is still buying these houses, and they're paying more than ever. To figure out who that is and how they're doing it, we first need to get a handle on just how massive this affordability crisis really is.
Just look at this. Look at how fast the bottom dropped out. A Redfin report from 2022 had this absolutely stunning statistic. Back in 2021, a solid 60%, a majority, of homes for sale were considered affordable for a family with a median income. Okay, reasonable enough. But just 1 year later, that number had crashed to 21%. Seriously, let that sink in for a second. In just 12 months, almost 2/3 of all the affordable houses in the country basically just vanished. This is, without a doubt, one of the lowest points for housing affordability in modern history. So if prices should be coming down, but they're not, what is really going on here?
All right, to get to the bottom of this, we're going to break it down piece by piece. First, we'll look a little deeper at the paradox itself. Then, we're going to pull back the curtain on something called the down payment illusion. After that, we'll talk about the great market gridlock, why no one is selling. Then, we'll pinpoint who's actually left buying houses. We'll get into the real root of the problem, the idea that your house isn't just a home anymore. And finally, we'll talk about how you can actually play this brand new game. You know, the paradox is pretty simple on the surface. It's economics 101. When demand goes down because things get too expensive, prices are supposed to fall to lure people back in. But that's just not what's happening. The housing market seems to be playing by a whole different set of rules. And the first rule is that what you earn and what a house costs are on two completely separate tracks heading in opposite directions. And here it is in plain numbers. According to Forbes, the average salary in America is about $59,000 a year, and that's before tax. Now look at the other side. In just 3 years, from the beginning of 2020 to early 2023, the price of an average American home jumped by $100,000. So think about that. Over that period, the average house earned almost double what the average person did. You literally cannot work hard enough to keep up. You can't get a big enough promotion to close a gap that's widening that fast. And that fundamental disconnect, well, that's the foundation of this whole problem.
So this brings us to the first big reason that prices are staying sky high. See, the whole industry has shifted its focus to make sure the market doesn't completely seize up. They've changed the conversation. It's not about can you afford this house for the next 30 years? It's now can you afford the ticket to get in the door? And that is a subtle but really profound shift.
This one sentence, this explains so much about the modern market. The financial world figured out that the sticker shock on a $500,000 house is just too much for people. But a down payment, that feels kind of manageable. It feels like a goal you can actually hit. By getting buyers to focus only on that first hurdle, the total cost and the decade of debt just sort of fade into the background. It decouples the price of entry from the actual price of the asset, and that creates a market that can support prices that are way beyond what people can comfortably afford.
Let's make this real. Let's meet Alex. Now, Alex is doing everything right. Everything we were told to do. Good job, disciplined saver, and after all the bills are paid, Alex manages to put away an impressive $15,000 a year, specifically for a house. At the start of 2023, the average home is about $330,000. So the traditional 20% down payment is $66,000. Alex's plan is simple. It's logical. Save like crazy for about 4.5 years, and that dream home is theirs. It feels totally achievable. But here is the cruel trap of this new market. While Alex was diligently saving, packing lunches, skipping vacations, the market was not standing still. Let's assume a pretty modest 5% price increase each year, which is actually less than we've seen recently. Well, that same $330,000 house is now worth over $400,000 4 years later. And suddenly, that 20% down payment Alex was aiming for, it's not $66,000 anymore, it's $80,000. The goalposts haven't just moved, they're sprinting away while Alex is running flat out.
And this right here, this shows the brutal math of this losing race. After 4 years of disciplined saving, Alex has 60 grand. I mean, that's an amazing achievement. But the target is now 80 grand.
So even after doing everything right, Alex is now $20,000 short, even further from owning a home than when they started saving 4 years ago. This is what so many people are feeling. It's like you're trying to fill a bucket that has a hole in the bottom. So how does anyone even get in?
Well, the industry's answer is pretty simple. If you can't clear the bar, just lower the bar. Lenders know that hitting a 20% down payment is basically impossible for most people now. So they changed the rules. The National Association of Realtors found that the average down payment for a first-time buyer is now just 7%. Some companies have even experimented with 1% down payment loans. This keeps the whole transaction machine humming. It lets more buyers squeeze in, which keeps demand artificially high and pushes prices even higher, even if it means those buyers are taking on way more debt and way more risk.
So, okay, that explains how buyers are stretching themselves thin to get in, but that's only half the story. The other half of this paradox is all about supply, or more specifically, the shocking lack of supply. There's this powerful, invisible force that's keeping millions of homeowners from selling, creating this massive traffic jam on the real estate highway.
And that force has a nickname, the golden handcuffs. Think about it. Over 80% of homeowners who have a mortgage right now have an interest rate below 5%. A huge chunk of those are even below 3%. So imagine you refinance back in 2021 and you locked in a 2.8% rate on a $400,000 loan. Your monthly payment is about $1,640. Now let's say today you sell that house and buy another one for the exact same price. Your new rate is going to be closer to 7%. Your new monthly payment? Over $2,600. That's an extra $1,000 a month forever just to live in a house of the same value. You're effectively a prisoner in your own home. It's a golden cage, you know? You've got this amazingly valuable thing, but you literally can't afford to leave it.
And this isn't just some theory. The data is really stark. In that hot 2021 market, 6 million existing homes were sold in the U.S. Today, that number has dropped to an annualized rate of just 4 million. That's 2 million transactions, 2 million families that might have moved for a new job or because their family grew or to downsize, that just aren't happening every year. And that's why when you're scrolling through listings, it feels like you're seeing the same few houses over and over. Sellers are staying put, and that's creating a severe inventory shortage that forces the few buyers left to fight over scraps, which keeps prices stubbornly, painfully high.
So, if regular buyers like Alex are running in place, and regular sellers are tracked by their own great interest rates, who is actually left in the game? Who is keeping this market so active and so expensive? Well, it turns out it's not a very diverse group. It's really just 3 very specific types of buyers who are mostly immune to the problems of high prices and high interest rates. Okay, let's break them down. First up, you have the all-cash buyers. A huge slice of this group are downsizing boomers. Maybe they bought their house in the 80s for, say, $80,000. They sell it today for $700,000, and they walk away with a giant pile of cash. They don't need a mortgage for their next place, so high interest rates just don't matter to them. Second, you have the relocators. They're playing a game of what you could call geographic arbitrage. This is your tech worker who sells a tiny condo in San Francisco for $1 million and moves to a cheaper city where they can easily outbid local families with a huge all-cash offer. And third, the group that's had the most dramatic impact of all, the investors. This number, it's just wild. While regular people were getting priced out, Redfin data shows that the year-over-year growth in home purchases by investors hit an incredible 145% in 2022. This isn't just growth, it's a fundamental market shift. This group isn't buying a place to live, they are buying an asset to produce a return. They're playing with different math, and their explosive expansion has totally changed the game, which leads us to the deepest and maybe most important reason for this whole mess. This is really the final piece of the puzzle. It's the big, underlying shift that makes everything else make sense. See, for generations, the main value of a house was as a place to live, a shelter, a place to raise a family, to be part of a community. But that has changed. We've stopped pricing houses primarily as homes and have started pricing them as financial assets, just like stocks or bonds. And the main way this happens is through something called a REIT, which stands for Real Estate Investment Trust. The easiest way to think about a REIT is that it's kind of like an index fund, but for property. It pools money from investors all over the world to go out and buy up a massive portfolio of real estate. Now, historically, that meant things like office buildings and shopping malls, but after the 2008 crash, they found a whole new untapped market, single-family homes.
This is maybe the best analogy I've ever heard for what's happening. Imagine a world where you couldn't just go buy a single movie ticket. To see any film, in any theater, you had to buy a monthly subscription to the one company that owned them all. That is the fundamental business model here. They aren't selling you a home, an asset you can own.
They are selling you access to shelter as a subscription service. We just call it rent. They are transforming homeownership into permanent rentership.
And this brings us to the most critical thing to understand. When you, as a family, make an offer on a house, you are no longer just competing against another family's salary. You are competing against a Wall Street algorithm. And that algorithm doesn't care about the good schools or the park down the street. It is calculating one thing and one thing only: the total amount of rental income that house can generate over the next 30 years. It's buying a future stream of cash. And that is why prices have totally disconnected from local wages. The price isn't being set by what people in the community can afford anymore. It's being set by a global financial market.
Okay, I know. Understanding all of this can feel, well, pretty discouraging. It can feel like the whole game is rigged. But knowing this stuff is power. The old rules of work hard, save up 20%, buy a house, and live happily ever after, they just don't really apply like they used to. The game has changed big time. But that doesn't mean you can't play. It just means you need a new playbook.
So what does this new playbook look like? Well, here are 3 modern strategies. First, there's house hacking. This means you stop thinking about just buying a single-family home and you start thinking about buying a small multi-unit place, a duplex or a triplex. You live in one unit and you rent out the others. Your tenants are basically paying your mortgage. You turn your biggest liability into an asset that makes you money. Second, if you can't beat them, join them. If REITs are the ones driving off the market, you can invest some of your savings in a publicly traded REIT. That way your savings can actually grow at the same pace as the market, so you don't fall behind like our friend Alex did. And third, there's community power. Co-buying with friends or family isn't a last resort anymore. It's a really smart financial strategy to pool your money, combine your incomes, and boost your buying power in this crazy market.
So in the end, that simple dream of owning a home has gotten really complicated. It's tangled up in these huge forces of finance, market gridlock, and this illusion of affordability. But by understanding these new rules, you can change your strategy. You can find creative ways to build wealth, whether that means finding a new path to owning your own place, or just by building a financial portfolio that outsmarts the very system that feels stacked against you. The game has definitely gotten harder, but it's not over. Now you know the rules.